For more than a decade, U.S. shale reshaped the global energy system. It turned the United States into the world's largest oil producer, reduced dependence on imports, and altered the balance of power in global oil markets. But today, something quieter is happening. U.S. shale production is no longer surging. It is not collapsing either. Instead, growth has slowed and largely stalled. This shift has received far less attention than earlier shale booms, but analysts say it could have long-term consequences for energy prices, investment, and security. Here is what the data shows, why this slowdown is happening, and what it means for the future of U.S. energy. U.S. crude oil production currently sits at around 13 million barrels per day. That level represents a historic high. However, it also marks a clear change from the rapid expansion seen during the late 2010 years and the post-pandemic recovery. Between 2017 and 2022, U.S. production rose sharply as companies raced to drill new wells and capture market share. Today, output continues preponderant, but growth has flattened. The weekly and monthly data show small fluctuations rather than sustained increases. According to analysts, this is not a temporary pause. It reflects deeper structural changes within the shale industry. To understand why growth has stalled, it helps to understand how shale production functions. Unlike conventional oil fields, shale wells decline very quickly. Many shale wells lose more than half of their production within the first year. That means companies must continuously drill new wells just to maintain existing output. Shale delivers fast results, but it demands constant capital investment. When drilling slows, production follows. This model worked well when capital was abundant and investors prioritized growth. That environment has now changed. The first reason for slower growth is geological reality.
Much of the most productive shale acreage in the United States has already been developed.
The best locations, PORPs, often referred to as Tier 1 acreage mochens, were drilled first.
Today, operators are increasingly forced to drill less productive areas.
These wells tend to cost more and deliver lower returns. As a result, each new barrel of production requires greater investment.
This has reduced the incentive for aggressive expansion, particularly when oil prices remain volatile.
Analysts describe U.S. shale as a mature industry rather than a growth frontier.
The second major factor is financial pressure. Following years of heavy losses, investors have pushed energy companies to change strategy. Growth at any cost is no longer rewarded. Instead, shareholders now expect dividends, share buybacks, and lower debt levels.
As a result, companies have limited drilling budgets, even when oil prices are supportive.
Executives have repeatedly stated that maintaining capital discipline is now a priority. This means production growth is deliberately being capped. This shift has fundamentally changed how shale companies operate.
Another important change is who now owns many shale assets. Private equity firms and financial buyers are playing a growing role. These investors often focus on short-term cash flow rather than long-term production growth. They tend to operate mature fields with limited drilling inventories. According to industry data, private capital now accounts for a significant share of upstream oil and gas transactions in the United States. This ownership model prioritizes efficiency over expansion. As a result, fewer new wells are drilled than in earlier shale cycles. This ownership shift further reduces the likelihood of rapid production expansion. Operational constraints also matter. The shale industry continues to face labor shortages, higher service costs, and supply chain challenges. Drilling rigs, equipment, and skilled workers are more expensive than they were a decade ago. These pressures limit how quickly companies can scale activity, even if they wanted to. Even supportive oil prices do not automatically translate into higher drilling levels. Companies must weigh costs, workforce availability, and supply constraints. This has reinforced a cautious approach across the sector. The result is a system that favors stability over expansion. A stalled growth profile does not mean U.S. production is declining. But it does mean global oil markets have lost a key source of rapid supply growth. In previous cycles, rising U.S. output helped cap global oil prices. With shale growth constrained, markets may become more sensitive to disruptions elsewhere. That includes geopolitical tensions, OPEC decisions, and unexpected supply outages. Without fast U.S. supply growth, those events carry greater weight.
Analysts say this could increase price volatility over time.
The era of shale acting as a global price stabilizer may be fading. There are also implications for energy security. That U.S. shale played a central role in reducing reliance on foreign oil. While production remains high, slower growth limits the country's ability to respond quickly to future supply shocks. In earlier years, rapid shale growth acted as a buffer during global disruptions. That buffer is now weaker. At the same time, allies and trading partners have built supply chains around stable U.S. output. Any long-term stagnation could alter those dynamics. Energy security, analysts say, increasingly depends on stability rather than rapid expansion. Most analysts do not expect a return to the explosive shale growth of the past. Instead, they anticipate a more stable, slower-moving industry. Production will continue. Investment will remain selective. Returns will matter more than volumes. Shale is no longer a revolution. It is an established part of the energy system, and its future will be defined by discipline, not rapid growth. U.S. shale has not failed. It has matured. Growth has stalled not because of a single shock, but because of geology, finance, and strategic choice. For energy markets, this marks a quieter but important transition. For policymakers and consumers, it means future supply will depend less on rapid expansion and more on careful management. Decisions on investment, regulation, and infrastructure now carry greater weight. The era of rapid shale expansion is over.
Clarvex News will continue to follow how this shift reshapes global energy markets.